Good Monday afternoon, everyone. On the 21st day of December 2020, a year that feels like, I guess, a decade. This is actually going to be a short video. I know I say that a lot, and I am definitely not known for brevity, which I know. But today, I'm really just going to cover one topic, and that is my top year-end financial tips. So we're really not going to talk about the greed nor the euphoria in the markets. If you're reading the blog, you know how I feel. Except for the dot-com bubble in probably 1929, there's never been a period with more greed and euphoria than we're seeing right now. But I'm going to put a pin in that, a topic for another day, a video, a blog, but I promise I'll talk about that sooner than later. So for today, the reason I'm doing the video is because I had this segment earlier today on Fox 61 in Connecticut, and the show ran long and my segment was right up against a hard commercial break. So it got cut pretty short, and some folks emailed and posted on social media that they wanted the full list. So without further ado, here are my top, I don't know, dozen or so maybe, year-end financial tips. There's something here for everyone. If you like what you are hearing and seeing, although not a referendum on looking at me, but if you like the tips, please give it a thumbs up on YouTube. So without further ado, let me preface my comments by saying this list is predicated on taxes not going up next year. So how would that happen? Well, the Georgia runoff in a couple of weeks has to say either all red or a red and a blue. If both seats go blue, then you can just hit delete all my comments here, or not all of them, but a lot of them would be moot and absolutely useless. But I'll talk about the Georgia runoff again in another video, because that is important. So this is, again, assuming taxes are not going to go up next year. The Senate stays red. Whether you like that or not, it's your opinion, and we move on. So first, this time of year, I know I personally every year do a dry run through of my taxes. I figure out where I am within a few $1,000s to decide if I'm going to forego taking income this year and push it out into next year. Am I going to accelerate my expenses this year, push them out into next year? It's not that hard. And you don't need every single expense and income item. But in a general sense, doing a dry run through before year end certainly can pay dividends come tax day in April. 1. 2, I want you to harvest capital losses. That means if you own JetBlue or American Airlines and you still like the airlines and you still want to own them, but you have a loss, sell the stock. Then so if you sell American, you can go buy United. If you sell United, you can go buy Delta. You sell Delta, you can go buy Southwest. There's also an ETF, exchange traded funds, JETS. No, not the the hapless, inept, incompetent New York Jets, who had a generational quarterback in their sights that would have finally changed our fortunes. But no, the Jets had to go win a meaningless game in December. That meant absolutely nothing. And now Jacksonville is going to end up with the #1 pick in Trevor Lawrence. I digress. It was one of the worst things I've ever seen. And this just shows you how unbelievably incompetent. They should fire every single staffer on the Jets. Okay, I'm sorry about that. Harvest your capital losses. JETS is an ETF that you can use in the airline. I'm just giving you an example. Sorry, I got sidetracked. While on losses, you can take up to $3,000 in capital losses every year on your 1040. So if you pair up your gains with your losses and you lose $10,000, you can write $3,000 off your taxes, and the remaining $7,000 carries forward into subsequent tax years until you exhaust all of those losses against future gains. So make sure if you've got losses, this is the time of year to take them. Don't carry your losses and then decide to take them in January. Doesn't make a whole lot of sense. The CARES Act, which was passed in April, allowed retirees to forego their RMD, their required minimum distributions taken out of their IRAs and 401ks. So do you take your RMD or do you forego it? the general answer is if you don't need the money, you should forego it. Why pay the tax this year? The only reason you would do that, I'm sure there are a bunch of reasons, but one of the reasons you would do that is if you're going to need more money next year and you would take more money out of your IRA next year. Well, then take it this year to smooth your tax bill out. But most people, I've said, if you don't need the money, leave it in, let it run, and you can take it in January through next December and then pay the tax on it in April of 2022. You can also take your RMD if you decided to, and you can give it to charity up to $100,000, a QCD, qualified charitable distribution. You could do that now, but really, if you're talking about an RMD, you're probably best off considering doing that in January, February through next December. So you don't pull the money into your account, into your pocket from your IRA. You fill out a form and it goes right to the charity, which is much better for you on a tax basis. Let's go on. Now, if you did not take your RMD, required minimum distribution, and also the CARES Act changed that for you folks who are 70 and over. It used to be 70 and a half, but now it's 72, which is a good thing. So the government did do something nice for us. They did a bunch of nice things in 2020 for us. But if you didn't take your RMD this year, as a lot of folks did not, and you're in a tax bracket and you're not bumping against the next bracket, you should consider doing a Roth conversion, taking some of the money in your IRA, converting it to a Roth, paying the tax, keeping below that next tax bracket, because future withdrawals from that Roth, first of all, growth is tax deferred. You don't pay any money on as your Roth grows. When you pull money out of your Roth, you don't pay tax either. So that's a pretty neat strategy to take this time of year, especially if you didn't take your RMD. Let's see what else. Charitable contributions. So that controversial aspect of the Trump tax cuts, where they put a limit on state and local deductions, meant that a lot of people couldn't fully take advantage of doing equal charity every year. That normal, let's say if you did 500 or 5,000 or 50,000, you were much better off stacking your charitable contributions. So either in all the years that are even or all the years that are odd, lumping your charitable contributions every other year so you can have a deduction big enough to weigh it against the standard deduction. What's the standard deduction, you ask? I'm not a tax expert, and you should always consult a tax expert. Standard deduction is the amount that the government gives each individual, $12,400, each married couple, $24,800. That's your deduction that you get right off the top, so you don't have to itemize. And I think with when they raise that level up, I think they estimate 70% plus of Americans are filing the EZ form, that 1 or 2 page form, with taking the standard deduction versus itemizing. So the reason you would stack your charitable contributions is you take the standard deduction every other year, and then every other year that you have big charitable contributions, you would itemize, and then it'd be a win-win, even though you still got to pay Uncle Sam. Okay, let's move on. The CARES Act allowed every American one time in 2020, if you make a cash donation, cash check, credit card, to a charity of $300, a one-time $300, that becomes a tax reduction, not a deduction. It comes right off the top line of your income versus further down after you filter everything through. So highly recommend that you take a $300, make a $300 cash donation to a charity. These are for folks who take the normal standard deduction, the 12, 4, and 24, 8. Also a good time of year if you've got stock, especially Apple, Microsoft, Facebook, Zoom, any of the stocks that really melted up the side of the page. You know, it's not a bad thing to donate some of that appreciated stock to charity. Boy, the charities could certainly use it. So you don't pay the tax on it and you get a write-off. So it's also kind of a win-win. Let's see what else. FSAs, flexible spending accounts. These are use them or lose them. In 2020, you could have up to $2,750 put in your FSA this year. If you don't use that money up, it goes bye-bye. So make sure you use it up. I won't tell the story on the video, but years ago, my wife and I were using up our FSA with, I think it was drugstore.com. And we got some very interesting stuff put into our package when it arrived that my dad opened, but I'll share that on an individual basis. Okay, let me finish up because I want to keep this quick. 401ks, we only have what, a week and a half left in the year. If you can add more money to your 401k now, if your employer will allow it, if you don't need the cash flow, let's put the pedal to the metal, put some more money in your 401k. 19.5 is your limit if you haven't reached the age of 50 yet. The government says if you're over the age of 50, you can add an additional $6,500 to your 401k. 529 plans, those college plans that parents and grandparents and aunts, uncles do for kids, little kids, etc. Some states allow you to get a state income tax deduction if you put money into a 529. So that's something to consider if you're looking to reduce some income tax burden as we get to year end. If you're lucky enough to earn a bonus in 2020 and your employer will allow you to defer that money to 2021, defer the money because you won't pay tax on that until next year. And frankly, depending on how you get taxed, you may not owe the tax on that until April of 2022. Each individual in this country can gift up to $15,000 to another individual. If you have a large estate and you're looking to whittle it down little by little to avoid estate taxes, giving $15,000 a year to somebody else, preferably in your family, although I am certainly willing to accept any and all $15,000 gifts. Consider that year end. You can do that by December 31st and again on January 1st, count as 2 different years. We're late in the game, but I keep pointing over there because my clock's over there with my little date on it. We're late in the game, but I always say end of the year, beware of the mutual fund distribution tricks. Sometimes you can buy a mutual fund on a given date and the next day they pay out a rather large capital gain distribution, which becomes immediately taxable to you. So I know over the years, I do my best for clients to avoid those, but every once in a while, I wake up with egg on my face because I realize a fund that we own paid out a large distribution and it becomes immediately taxable. So be careful of that. My last one on the list is check your withholding. If you get paid W-2 wages, you work for a company, you get a paycheck with a stub, ADP or Paychecks, or one of those other horrible companies, make sure your withholding is enough to cover your taxes. The last thing you really want is to underpay enough so that you're going to have to pay estimated taxes on a quarterly basis in 2021. So I think for me, this was pretty short. That's my list of the top year-end financial strategies that any and all should consider. Consult your tax advisor, please, before taking these for sure. Again, it's December 21st. I'm going to work on some more videos on the greed and euphoria in the markets. Right now, my left foot is absolutely freezing because I'm still recovering from surgery. I took my little boot off that protects it during the day. And the floor in my office feels like it's about 35 degrees. You could hang meat on it. So I've got just sitting here in a sock with no shoe on and my foot's freezing. So with that, I'm sure you really cared about that. But in any case, if you like what you heard, saw, please give me a thumbs up on YouTube. Any questions, comments, concerns, you can email me, paul@investsfortomorrow.com. And I wish you a continued, very happy, safe, healthy, peaceful, and sane holiday season. Now I have to figure out how to stop recording this.